Happy day, students. I am Nivedha Rajid, Assistant Professor from the Department of Human Resource Management of Dr. MGR Educational and Research Institute University. So today in Business Accounting, we're going to see part 4 of Unit 1, that is Accounting Terminologies. So let's see what are the accounting terminologies included in this PPT. Balance sheet terms. Balance sheet is one of the two most common financial statements produced by accountants. This section pertains to potentially confusing terms that relate to the balance sheet. We have account payable, which is also called as AP. Accounts payable include all of the expenses that a business has incurred but has not yet paid. This account is recorded as a liability on the balance sheet as it is a debt owed by the company. Now let's see what is accounts receivable, and it is also called as AR. Accounts receivable include all of the revenue that a company has provided but has not yet collected payment on. This account is on the balance sheet, recorded as an asset that will likely convert to cash in the short term. Now let's see what is accrued expenses. An expense that has been incurred but hasn't been paid is described by the term accrued expense. Let's see what is asset. Anything the company owns that has monetary value. These are listed in order of liquidity from cash to land. Now let's see what is a balance sheet. A financial statement that reports on all of a company's assets, liabilities and equity. As suggested by its name, a balance sheet abides by the equation, that is asset equal to liability plus equity. Now let's see what is a book value. As an asset is depreciated, it loses its value. The book value shows the original value of an asset less any accumulated depreciation. Now let's see what is equity. Equity denotes the value left over after liabilities have been removed. Recall the equation, that is assets is equal to liability plus equity. If you take your assets and subtract from your liabilities, you are left with your equity, which is the portion of the company that is owned by the investors and owners. Now let's see what is inventory. Inventory is the term used to classify the assets that a company has purchased to sell to its customers that remain unsold. As these items are sold to customers, the inventory account will be lower. Now let's see what is a liability. All debts that a company has yet to pay are referred to as liabilities. Common liabilities includes accounts payroll, accounts payable and loans. Up next we have cost of goods sold. Cost of goods sold are the expenses that directly relate to the creation of a product or service. Not included in this category are those costs that are needed to run the business. An example of cost of goods sold would be the cost of materials or the direct labor to provide a service. Now let's see what is depreciation is all about. Depreciation is the term that accounts for the loss of value in an asset over time. Generally, an asset has to have substantial value in order to warrant depreciating it. Common assets to be depreciated are automobiles and equipment. Depreciation appears on the income statement as an expense and is often categorized as a non-cash expense since it doesn't have a direct impact on a company's cash position. Now let's see what is gross margin. Gross margin is a percentage calculated by taking gross profit and dividing by revenue for the same period. It represents the profitability of a company after deducting the cost of goods sold. Now let's see what is gross profit. Gross profit indicates the profitability of a company in dollars or rupees without taking overhead expenses into account. It is calculated by subtracting the cost of goods sold from revenue over the same period. Now let's see what is an accounting period. An accounting period is designed in all financial statements like income statement, balance sheet, and statement of cash flow. The period communicates the span of time that is reported in the statements. Now let's see what is allocation. The term allocation describes the procedure of assigning funds to various accounts or periods. For example, a cost can be allocated over multiple months, like in the case of insurance, or allocated over multiple departments, as in often done with the administrative cost for companies with multiple divisions. Now let's see what is a business or a legal entity. This is the legal structure or type of a business. Common company formation includes sole proprietor, partnership, limited liability, cooperative societies, etc. So each identity has a unique set of requirements, laws, and tax implications. Now let's see what is a cash flow. So cash flow is a term that describes the inflow and outflow of cash in a business. The net cash flow for a period of time is found by taking the beginning cash flow or the cash balance and subtracting the end cash balance. A positive number indicates that more cash flowed into the business than out. Negative number indicates the opposite. What is a journal entry? Journal entries are how updates and changes are made to a company's book. Every journal entry must consist of a unique identifier, a date, a debit or credit, an amount, and an amount code that determines which account is altered. Now, what is a general ledger? A general ledger is the complete record of a company's financial transaction. The general ledger is used in order to prepare all of the financial statements. Now, what is a fixed cost? A fixed cost is one that does not change with the volume of sales. For example, rent and salaries won't change if a company sells more. The opposite of a fixed cost is a variable cost. Now let's see what is a trial balance. Trial balance is a listing of all accounts in the general ledger with their balance amount, either debit or credit. The total debits must be equal to the total credits, hence the balance. Now let's see what's a variable cost. These are costs that change with the volume of sales and are the opposite of fixed cost. Variable cost increases with more sales because they are an expense that is incurred in order to deliver the sale. For example, if a company produces a product and sells more of that product, they will require more raw materials in order to meet the increase in demand. Now let's see what is a receipt. A receipt is a document that proves payment was made. A business produces receipts when it provides its products or service, and it receives receipts when it pays for goods and services from other businesses. Received receipts should be saved and catalogued so that a company can prove that its incurred expenses are accurate. Now let's see what is return on investment. Originally, this term is referred to the profit that a company was making, that is the return, divided by the investment required. Today, the term is used more loosely to include returns on various projects and objectives.